backed by Huawei, CATL, and Changan, and sales still fell more than 50%. That's the line buried inside Avita's Hong Kong IPO filing, and it should make every EV investor stop and think. Avita just filed for a Hong Kong IPO, and the prospectus is one of the most revealing documents I've read about the Chinese EV market this year. Not because it's a success story, but because it isn't. The company is seeking a valuation of roughly 26 billion yen, which sounds like a vote of confidence from three of the most powerful names in Chinese industry: Changan Automobile, Huawei, and CATL. That's the automaker, the tech giant, and the world's largest battery maker all sitting at the same cap table. On paper, that's an unbeatable hand. But here's the number that stops you cold. In the first 7 months of 2026, Avita sold just 49,000 vehicles, and that figure represents a collapse of more than 50% compared to the same period a year earlier. I think that gap between the brand's pedigree and its actual sales trajectory is the central tension of this entire story, and the IPO filing forces it into the open in a way that no amount of press releases could hide. Let's talk about what 26 billion yen actually means in context, because the raw number doesn't tell you much on its own. The metric that matters here is price-to-sales ratio. How much investors are being asked to pay for every yuan of revenue the company generates. Based on Avita's annualized sales run rate, that ratio sits at roughly 1 times revenue. Now, that might sound reasonable until you compare it to Leapmotor, which is currently trading at about 0.75 times sales and is actually growing its volumes. Avita's ask is approximately 30% richer than Leapmotor's market price for a company whose sales are moving in the wrong direction. Before we go further, one number that changes the whole picture: Huawei's ADS smart driving system, the technology that is supposed to justify Avita's premium positioning, costs Avita a licensing and hardware fee that materially compresses its gross margin on every car sold. The mechanism here is important. Huawei doesn't just supply software. It supplies the full ADS suite, including LiDAR, compute hardware, and the algorithm stack. That's a bundled cost that sits on Avita's bill of materials, which means the more cars Avita sells, the more it pays Huawei per unit. I'd argue this is structurally different from, say, a Tesla that owns its own FSD stack outright. Tesla's software margin improves with scale. Avita's ADS cost is essentially a per-unit royalty that doesn't compress the same way. Here's where I have to be honest about something. 2 years ago, I thought the Huawei ADS partnership was close to a guaranteed differentiator, that any brand carrying that smart driving badge would command a durable premium in the Chinese market. I was wrong, and the Avita numbers are the clearest evidence yet. What I underestimated was how fast the competitive floor would rise. In 2024, Huawei ADS genuinely stood apart. By 2026, Xpeng's XNGP system, Momenta's stack inside Zeekr models, and even BYD's God's Eye system, which BYD is now offering on cars starting around 100,000 yen, have compressed the perceived gap dramatically. The Huawei badge used to signal exclusivity. Now it signals cost. This rhymes with what happened to early Mobileye integrations in Western cars around 2019 and 2020, when every mid-range European sedan suddenly had the same Mobileye IQ chip. The technology stopped being a reason to choose one brand over another and became a commodity expectation. Avita is caught in that same commoditization curve, but it's paying premium licensing rates for technology that the market no longer treats as premium. An Avita executive was recently quoted acknowledging that the brand's Huawei partnership hasn't translated into the sales velocity they projected, and I think that candor, rare as it is, actually tells you how serious the internal reckoning is. The other brands in Huawei's orbit, the 80M9, for example, are faring better largely because they sit in a different price band and have Series' manufacturing cost structure behind them. Avita's problem is that it's trying to be a yen 300,000 plus luxury EV in a market that is rapidly deciding 200,000 yen buys you everything you need. So what does this IPO filing actually force to happen over the next 12 to 24 months? I see 3 pressure points. First, Changan. Changan holds the largest strategic stake in Avita and cannot afford to let this become a public embarrassment on the Hong Kong exchange. I'd expect Changan to either inject fresh capital post-IPO or push hard for a product refresh cycle that brings at least one new model to market by mid-2027, specifically something in the 200,000 yen to 250,000 yen band, where volume actually exists right now. Second, watch Huawei's licensing posture. If Avita's margins stay under pressure, there will be a renegotiation. Huawei has done this before with AITO, structuring deals that blend equity participation with licensing to reduce the per-unit cash burden on the partner. If Huawei offers Avita a similar restructuring, that's actually a bullish signal for the stock post-IPO. If they don't, the unit economics don't improve. Third, the IPO price itself will be a market verdict on whether investors believe the Huawei story still carries a premium. I'd watch the order book carefully. If institutional allocation is heavily domestic Chinese funds rather than international money, that tells you global investors are skeptical. For comparison, when NIO listed in Hong Kong in 2022, international funds took a meaningful slice despite the losses because the brand narrative was intact. Avita doesn't have that narrative momentum right now, and a domestically skewed book would confirm it. So, bullish or bearish? Here's where I land. This is a pass at 26 billion yen and a speculative watch below 18 billion yen. Three things to remember from this. 1. A 50% sales collapse while carrying a 30% valuation premium over a growing competitor is not a buying setup. It's a warning label. 2. The Huawei ADS technology advantage has a shelf life, and BYD's God's Eye rollout at 100,000 yen price points means that shelf life is measured in months, not years. 3. The indicator to watch is whether Huawei restructures its licensing deal with Avita before or immediately after the IPO. That single move would change the unit economics enough to make the thesis worth revisiting. Now I want to hear from you. Do you think the Changan Huawei CATL combination is still a credible mode, or has the market already priced in that the halo has faded? Drop your number in the comments. What valuation would actually make you interested? And if you're new here, subscribe. We do this kind of IPO and valuation breakdown every week for Chinese new energy vehicles. If you found this breakdown useful, subscribe, and tell me in the comments what valuation you'd actually pay for Avita. A specific number, not a vibe.